Good people, welcome back to Stock Up with Larry Jones. On today's video, first of all, I'm going to timestamp it, okay? So you could rewind and go to your prospective places. We're going to talk about tax harvesting. We're going to talk about tax loss harvesting. We're going to talk about short and long capital gains tax. We're going to touch on ETFs, 401ks, Roth IRAs, all kind of tax shelters, especially the ones that the rich take advantage of that a lot of us don't know about. I have two experts here today. And remember, I will never ask you to send crypto or cash anywhere. I will never talk about a WhatsApp. This is my broker. That's all spam, okay? And at the end of this video, make sure you check out all of the links, all right? Let's get right into it. Hey, today we're going to talk about taxes on gains, right? And so first, introduce yourself.
Yeah, my name is Eli Rosario. I'm a CPA. That means Certified Public Accountant. I know you guys know about the accountants. I'm your guy. And so
AKA Rico Suave.
Rico.
So let's start off with what is capital gains?
Sure. You know, capital gains is really the sale of any asset. Sometimes, especially for investors, you think that it's only related to the investment account, but it's the sale of anything. Property, real estate, it could be a boat, it could be, a vintage car, artwork. But what you guys are literally interested in is how does it affect your investment accounts? Capital gains actually represents the gain that you get from the cost minus the sale of an asset, or in this case, a stock. It could be crypto, it could be any type of stock, and that net gain represents capital gains. And
so the net is what you keep.
It's what you keep.
What you made, not your initial investment, but the gains that you made off of your profits. Correct?
That's correct. So it's the cost of the stock, also the commission that you expend on that stock, and then it's subtracting the sale less any commissions, and that net number is what it is. That's what represents capital gains for you.
How much taxes do you have to pay on long-term investments, right? So let's deal with long-term and then we'll get to short-term. Number one, explain what is a long-term investment and then explain the taxes on it.
Sure. Yeah, long-term is actually really easy. It's anything over 12 months. So if it's 1 day over 12 months, that is long-term. That's from a tax standpoint. So when you think about long-term capital gains, the way that they're calculated is we talked about gain versus loss, and so you get that overall gain. But the long-term side of it is actually taxed in three different ways. You pay zero tax, you pay 15%, or you pay 20%. And the way that it's calculated can be actually quite simple. If you want, I'll explain it.
Please do.
So,
Please do.
So look at
I'm
it,
here to help the people.
So look at it this way, as you know, from a capital gain standpoint, the things that are going to be relevant to you is how long have you been in an investment, is what is your tax bracket or your income level, and it's also whether or not you're married filing separate, married filing joint, like your marital status, or whether or not you're head of household. Those things are going to affect your tax itself. And so when you look at long-term capital gains, they're going to be taxed based on those variables. Really simple example. If your income for a single person, right, if your income is between $0 and $40,000 on an annual basis, you're going to pay that 0% on the long term. If you're between 40 and let's say 440,000 or so, this is about 2020 tax rates, you're going to be in the 15% bracket. And if you're over 440,000, then you're going to be in the 20%. And that's how you calculate the long-term capital gains tax. It's also will vary based on whether or not you're married filing joint, married filing separate, or head of household.
Wow. Okay. The flip side of that, explain what short-term is, and then the taxation on that.
Yeah, short term, is obviously the direct opposite of long term. It's within 12 months. right? So the day that you purchase versus the day that you sell. If it's within 12-month period, then it's short term. The tax rate on the short term is based on your ordinary income. So whatever your tax status is, that's what you're going to pay based on any gains that you have in the short term standpoint. It's important to note, right? When long term, you know how you get that zero tax between 0 to 40 for individuals. For short term, you're going to pay tax, right? It's going to be something like 10%. It could be 12%. It could be 22, 24, 32, 35, 37, depending on where you are in that scale. And that's how short term is calculated.
So day traders and swing traders are going to pay higher taxes than someone that invests, has an equity, and holds it for 5 years.
That's generally yes, right? But,
yes.
But then you can be strategic about it. You can do different things to offset it. But it is based on whatever your income is.
Name one of the things that we could be strategic, just like the wealthy, and offset the gains. Go ahead.
Yeah, I mean, so obviously there's capital losses that can be incurred as well, right? You have capital gains, those same transactions can generate a loss. And so if you take a loss and you offset it against the gain, you actually, at the right time, strategically, you can actually reduce some of that impact. And, obviously the issue of deciding when something is long-term versus short-term can make a big difference in your tax bracket. Capital gains apply to other things as well. And so let's just say on your tax return, you actually have some form of investment gains. Maybe you have a capital loss that you can use to offset even investment gains in your stocks. And so there's great strategy available for capital losses. Here's the thing. You can offset a capital loss against a capital gain even. So if you have $100,000 worth of capital gains and $100,000 worth of capital losses, you can wipe them out on your tax return. If you have a loss beyond, so you're $105,000 against $100,000 of gain, you only can take the $3,000 additional. So you can take $103,000 worth of capital loss in the current year, and then the remaining two that I mentioned, right, 105, you actually can carry those over into future years.
Wow! For those of you that's investing and you buy an equity, you buy a stock, and it drops in value. And then you sell it the same day or the next day, and then you buy it back in and you see that W, that's a wash sale. So explain what that is.
Yeah, so we talked about capital losses. When you actually do a sale, it turns into a loss, and you're using and trying to get the tax benefit of that loss. It can be offset if within a 30-day period you turn around and you buy that transaction again. In theory, that's a wash sale. And so the IRS doesn't want you to take advantage of that tax benefit and then turn around and buy the asset at a really low price. So and what it literally does is those sales offset. They literally wash themselves out. You will not get that tax benefit.
And exactly. And so let me explain this. Let me add to that. So a lot of you, and if this is helping you, leave me a comment. A lot of you will see, let's say you buy something for $10, right? It drops to $8. And then you sell it, you're like, I'm cutting my losses. Then you go, wait a minute, I want to get back in the next day, right? And so you buy it again and you put a limit order to buy it at $9. Let's say it dropped to $7, right? You bought it at 10 and you sold it at 9, it drops to 7. And you put a limit order to buy it at $7 and it fills. And you think you bought it at $7. But when you actually looked, you actually bought it at a higher price. And that's what it does now for the tax sale. And you get for the wash sale. So you think you bought it at a lower price. It actually goes, nope. Just like he said, you can't buy it back at this price. That's a wash sale. We're going to fill your order, but you're actually buying it back at a higher price. So a lot of people have been seeing that and they're going, wait a minute, what's going on? That's part of the wash sale, right? And,
30 days.
30 days.
30 days.
So what you have to do is wait 30 days and then rebuy it. Okay, so there's a lot that we need to know. We are not going to just load up the boat here. We're going to balance the boat, good people. I'm going to cut it off.
Can I share one more thing?
Please, go ahead.
Before we're gone, you
Yes.
know, we talked about capital gains, but it only applies to taxable accounts, right? Capital gains don't apply to things like IRAs, any of those non-taxable accounts. So it is relevant for you to know that as you consider, the implications of taxes.
Check out them links below. All right.
But, so what an ETF is, you guys are probably trading a lot of individual stocks. And so as individual stock goes up and down, what a ETF does is diversifies. So instead of just buying one, you buy maybe 500 different stocks, 1,000 different stocks within a single cup. And so what happens is now instead of just having the one stock fluctuating up and down, you got the cup moving up and down with the broader general market. So what an ETF stands for is an exchange traded fund, which means that it is mimicking or copying whatever the fund or the indice, the S&P 500, NASDAQ, Dow Jones.
Those are
IFA.
exchanges.
Yes, those are all exchanges that an ETF can mimic. And so what's happening is that fund is using a lot of the different investments on the exchange within your portfolio that you own. And so that's very similar to a mutual fund, which is the same exact concept, except for what's happening with a mutual fund is someone is actively managing, putting money into it, changing investments, moving. So there's an active person being paid on a daily basis to manage that fund. So the difference between the two, active manager day to day, there's a guy or gal managing that money. An ETF does not have that person watching every day. So this one's going to be managed, more.
Hence the fees.
Yes, and therefore less expensive.
ETFs
I don't
are
have
less
someone to pay to manage for an ETF. I don't have someone to pay to manage it on a daily basis because it's either computer generated or they watch it much less often, monthly, quarterly, even
and that
annually.
does not mean that a mutual fund is going to automatically perform better.
Right.
Yes, it just means that it's just you're paying for the work done. So the mutual fund has someone daily, and an ETF has someone passively.
Correct.
Yep. So you want to pick ones that are and those of you that sleep on ETFs and mutual funds, some of those, especially over the last couple of years, have outperformed your trading. I guarantee it. All right. Go ahead.
I'll also say you can't day trade 401ks. Right, you can't if you're an employee and you have a job and you have a 401k, you can't go in there and buy individual stocks most of the time.
Yeah.
You have to use mutual funds or ETF or an index, which is another derivation of a combination of the two, right? But you have to use those funds, and so knowing what they are, how they work, and seeing the difference in expenses can, number one, save you some money in fees, but number two, they work for you if you're picking the right ones.
That's very good. But now in a Roth IRA, you can buy and trade daily.
Yes, correct.
Yeah, and so that's the beauty of it. So here's another comment that I get sometimes. If your Roth IRA is growing, let's say you killed it and you did 50%. So you made 50% gains, right? Which is killing it. It does not limit the amount that you could contribute every year still. Right? So now, my name is Jim Bob. Hey, how you doing? My name is Jim Bob.
Pleasure.
And I've never put any money into a Roth IRA. I'm 52, which means that I could put $7,000 in, right?
Yes.
I'm just hearing this video, right? But I got a bonus coming next year, January 15th. Can I use that money for this year?
Absolutely, you can. So April 15th of 2022 is the deadline for 2021's contributions. So you can put in your $6,000 if you're under 57, if you're over, until the tax deadline, which is it's normally April 15th. Last year they kind of switched things up on you in 2020. They gave you a little bit longer, but April 15th is generally the deadline.
That is cool. Great. I got y'all, family. I got y'all. see, these guys are above my pay grade. I got the answers. I don't know all the answers, but they do. I always say I am not an advisor. He is. I'm not a professional. He is. All right. So I want to come back to the CPA, and I want to ask, is there anything that is like, if you wanted to tell somebody that's new, one thing right now in a nutshell today before the year ends, what would that be?
Well, we were talking about capital gains earlier, and the idea of gifting, some of your stock as a whole, as a way of reducing your tax burden. And so you can actually gift a stock to a charity and actually get the full deduction for that.
That's heavy.
On your Schedule A. You can also gift stock to a family member that's in a lower tax bracket. He's looking at me and laughing.
Thanks, Dad.
The limit is $15,000, by the way. So.
That's right. So gifting of that stock actually allows for someone in a lower tax bracket to take advantage of that income at a lower tax, right? So there's, in essence, tax savings as a family.
A lot of people that's made a lot of money, they'll gift their kids, and that's what they do for tax write-offs,
That's right.
And or here's one of the things that I suggest for everybody, because remember, we're gonna make a lot of money from now to 2025. If you do a C Corp, you can also really, I would suggest, partnering yourself with a charity, because would you rather government take your money, or would you rather see your money go to work, right? And so I would partner with a charity, and I would rather give as much as I can to keep that money from going to the government. Nothing against the government. But I'm just saying, if you got that opportunity to give to the charity for the write-off, then I would really strongly suggest you're doing that, right? Wouldn't you agree?
I would.
Yeah.
I would.
Yeah.
And I would also agree, nothing against the government.
Right.
Can I just say something?
Yeah, say something.
So look, as a society, we live in a nation where the taxes that we pay actually goes to pay for the infrastructure.
Yes.
Right. For the schools, the roads, the blessings that we have in living in the United States. And so this is not a plug for taxation.
Right.
One of the benefits of our democracy is that we're able to decide.
Yes.
Like, we're able to be strategic about how we spend our money, how we deduct, to use the tax laws to our benefit. And so if you're really sharp, as he says this all the time, right? Like, the wealthy uses all of those benefits to reduce the implication. And in some ways, depending on the industry and how you work, you could actually wind up paying zero tax.
Yes.
Right? But the idea is not not tax evasion.
Right.
Right? It's just strategy. It's strategy.
Legal strategies that the 1% take advantage of. Do you know the top 1%? Most of them didn't pay any federal taxes.
That's right.
Elon Musk didn't pay any federal taxes last year because of strategies like this. So if you want to be rich, do what rich people do.
Amen.
That's the formula. Okay. Let's talk about custodial accounts. Okay. I know there's two main ones, but you guys, I want you to be serious about building future wealth. Okay. Generational wealth. The best way to do that is start out your kids with a custodial account. For those are not old enough to open up an account, you could open an account up for your kids and your grandkids. As a matter of fact, you could open up a custodial account for your nieces and nephews and your neighbors' kids. Talk about that for a minute.
Yeah, custodial accounts are great ways to save for someone else. And how they work is you're the account owner until that person, that beneficiary, that minor becomes what's called the age of majority is the technical term, but most states it's either 18 or 21 years old. And then at that point, that person becomes the sole owner of the account and you essentially get kicked off. So you want to talk about giving someone a running start, give them a chunk of money that's grown over time. Number one, that they have the pot of money, but number two, truly teaching them, right? Teach a man how to fish and he'll never be hungry again.
Come on, man, say that.
Teach them how to invest. Show them, I am putting money into an account for you, but I am going to make it grow. My son is 3 years old, and I ask him this question. I say, what do you do with money? And his answer is, I grow it, and then I give it away. And that's profound. The purpose of our wealth is to grow it, to be used in whatever fashion you see fit. I personally think giving to the kingdom is a great way to do that. But growing it so then you can give it away.
Yeah. When he says kingdom, he means church, good people.
Yes. Yes.
Because we're speaking of 40 different countries
Yep.
and
My
around the
apologies.
world. And you know what? Speaking of that, for those of us that are believers, we are taught, and I'm not, this is for your appropriate religions. I'm just telling you what we believe as Christians. We give 10% first, right? After that 10%, I say, you pay yourself 10% first. We got this thing all wrong, right? So pay yourself 10% first, then pay all your other bills. And if you can't pay all your other bills, then you need to rearrange your living. And we need to start our kids with that now. Pay yourself 10%. And when I mean pay yourself 10%, I mean invest it. Because if you truly want to build generational wealth, if you start off day one investing 10% over your lifetime, you will be wealthy. You will build wealth like none of your friends are going to build. And I don't care how much you're making, because, you know, it's just like my $5 a day concept. Eventually, you're going to be a millionaire by investing $5 a day. Even if you did it with a mutual fund or an ETF, eventually you will become a millionaire. And most will do it between 25 and 30 years. So just think, most people retire, they have to work longer now, and they're retiring at 68. Wouldn't you like to retire it? Be able to retire at 48 instead of 68? The earlier you start. So let's think about this. You start a custodial account with your child. The college one. Explain that one.
Yeah, a 529 plan is what he's talking about. So every state has a different plan, but it's essentially dedicated for college expenses, and what you're doing is putting money into it for, again, the beneficiary, your minor, and then when they get to college, it's supposed to be used for college expenses. Now, the difference, in my opinion, one of the greatest differences and benefits to it is the custodial account does not have a tax credit. The 529 plans, depending on your state, Indiana is 20%, a 20% tax credit for any dollar amount that you put in up to $5,000. So if I put in $5,000, I get $1,000 back for state income tax. Illinois is 10%, and then you'd have to check for all the other states, but that's one of the biggest differences, is you get deductions or credits depending on your state.
Okay. So just so I'm going to stream this live, good people. So I'm going to premiere this, rather, not stream it live. I'm going to premiere this. But I want you to say what you think is important for people to know now, whether it pertains to this year or next year. And then at the end of that, give them your email information.
Yeah, absolutely. So first question, I've got a couple rapid fire thoughts. Number one, take advantage of contributions, especially if your company matches. If you got a 401k and your company matches you 3%, 5% of whatever you put in, please, please, please take advantage. That's free money that no one else on the planet will give to you. It is a benefit of being an employee of the company. Second, take advantage of your contributions, Roth or traditional IRAs. You can't go back to previous years and put money in for 2020. We can't do that anymore. It's based on that tax year. So get your money in there and get the tax benefits for each of them. And then final point I'll make is I see a lot of different situations, and I would encourage everyone to just zoom out. You know, when the markets close, you're not trading, zoom out on your overall financial picture, your overall net worth. Look at how you're doing with your debt, with your monthly expenses. Are you spending more than what your income is? If so, that's a losing equation. If a company did that, they'd be pretty close to foreclosure, right?
Exactly.
So what you need to do is, if you're paying 25% on a credit card on a huge balance, and your portfolio is making 10 or 15, you're losing money between the difference of your credit that's outstanding and your investments. So zoom yourself out. Look at your long-term retirement plans, getting your kids' education funded, paying off your mortgage. Start really considering the benefits and drawbacks of your overall financial picture. And I think you'll see that having that holistic point of view is going to help you.
That's really cool. Give them your email
Yes.
information.
Yeah, it's Alec, ALEC .Rosario, that's ROSARIO at EDWARDJONES.com.
And he is licensed in many states, and there's nothing for him to get licensed. The last time we did this and had him as a guest, he had many of you guys hire him or do business with him. He really only gets paid by making you money. So it's like a no-lose situation. I think everyone, I don't care how much money you have and what your earning potential is, should have a
Financial advisor.
bam, to which I am not. But he is. My brother, go ahead.
Well, I would say this. Sometimes we wait until April 15th when we're getting ready to file our taxes to start planning for what happened the year before. You have to do that tax planning before the end of the year. And so right now is the time. We've got just a few days left. If there are things that you want to do to change your income tax equation, these next couple days are it. So really get in there and really think about those tax strategies. And if it's too late this year, look, next year, as Larry has indicated, a year of lots of profits for you guys as viewers, for the work that Larry does with us all. And, be strategic. Start now. Really start thinking about what the future looks like for your children, how you're going to invest, whether or not you're going to set up corporations, how you're going to take those tax benefits and deductions. And the next time we come on, I want to start talking about 1031 exchange.
Oh, we going to do that we doing that in January, good people.
Yes.
Yes, we doing that. Give them your info.
Yeah, my name is Elias Rosario, so you can reach me at Rosario, EROSARIO, at terrainmanagement.com. Terrain, TERRAIN, management, MANAGEMANT.com.
Now, these gentlemen I've known for many, many years. As a matter of fact, this gentleman is literally like a brother to me. He was the best man at my wedding.
That's right.
And so these are not guys that I found on the street. I was like, hey, you, come here. So I know these gentlemen. They've been in their fields for many, 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 many years. And that young man over there, whatever you think, however old you think he is, he's way older, at least by 10 years. And he knows his stuff. And so these gentlemen are part of my team. Everybody needs a team. You don't know it all. I don't know it all. So I come to these gentlemen for advice, okay? And so it doesn't matter. You go, yeah, Larry, this is what you do. You're in a financial space. You got to understand that they are professionals in these fields, okay? And so a wise man builds a strong team. All right, good people. So hopefully this has been helpful. Please leave me a comment if this has been helpful. Make sure that you are subscribed and make sure your notification bell is checked. Some people say that theirs were unchecked. I don't know what's going on. It's some fraganagle stuff going on. Fraganagle. And so make sure we're getting all of this information, and also to make sure that you check out all of the links below. All right, good people. We're going to leave it right there. Hey, make sure that you pass this information to anybody that you need, that you think will benefit from it. And we're going to have a prosperous year next year. Even if we go into a bear market, we know that those are buying opportunities. We're going to find stock that are beat down the most, and we're going to start DCA, dollar cost averaging, throughout the year. All right, good people. All right. As always, in parting, live, love, laugh, and learn. Peace.